Right now, I mean, halfway across the globe, an Iranian drone fails to hit its target.
Yeah.
Yet within milliseconds of that physical miss, an automated engine on some server rack triggers a liquidation cascade. And that completely wipes out a trader sitting in their bedroom betting on a synthetic space company.
It is wild, but welcome to modern markets. Everything is completely tethered together now.
Right, and welcome to NovaStream. If you just look at the screens around us on the 24/7 feed today, it's just chaotic. We have live crypto markets painting these dynamic sparkline charts in an absolute sea of red.
Oh, and don't forget the global financial indices.
Yeah.
They're flashing these historic, just massive green numbers at the same time.
Yeah, and the breaking news ticker, frankly, hasn't stopped moving since midnight. We want to say a massive hello to you tuning in from wherever you are right now on YouTube. Our mission today isn't just to let the sticker wash over us.
No, definitely not.
We are here to decode the mechanisms behind these moves and really just pull together the highlights of the day.
Because staring at raw price action on the feed without understanding the underlying plumbing of the market, I mean, it's like trying to read a book by only looking at the punctuation.
That's a great way to put it.
Yeah, the narrative today is incredibly fractured. But there are these powerful hidden currents connecting geopolitical shockwaves to this massive 25-year tech rally and then bizarre synthetic retail trading all the way down to domestic political battlegrounds right here in the U.S.
Well, let's start with the heaviest item dominating the breaking news feed right now, because it really is the domino that sets off everything else. I'm talking about the escalating situation between the U.S. and Iran.
Right.
We are seeing immediate, visceral reactions across two completely different asset classes today: oil and Bitcoin. Let's limit the physical commodity first, because oil prices are rallying for a third straight day.
Yeah, they really are.
The ticker shows WTI crude futures up nearly 10%. So for someone just watching that red and green text fly by, let's translate. What are WTI futures, and why is this specific metric spiking so hard?
Sure. So WTI stands for West Texas Intermediate, which is essentially the underlying benchmark for U.S. oil prices.
Okay.
And when we talk about futures, we're talking about financial contracts where buyers and sellers agree to exchange barrels of oil at a specific price on a set date in the future.
Got it.
Right now, buyers are willing to pay a massive premium for those future contracts because U.S. Central Command reported that Iranian drones attempted an additional wave of attacks on U.S. forces in Kuwait.
Even though the drones failed to hit their targets, right?
Yeah, they missed, but the commodities market doesn't really price in the physical damage. It prices in the probability of supply chain paralysis. They're betting that oil simply won't be able to physically move through the region next month.
It's a very tangible physical fear dictating that price. But, you look at the crypto sparklines on our feed, and Bitcoin is doing the complete opposite.
Oh, it's tanking.
Yeah, it just tumbled below $70,000 for the first time since April 8th. I think it hit a low of $69,500. And I really have to push back on the prevailing industry narrative here.
Okay, let's hear.
Well, for years, the crypto community has championed Bitcoin as digital gold, right? The ultimate geopolitical safe haven. The pitch to you is always, if the world gets scary, you hide your wealth in Bitcoin.
Right, that's the classic talking point.
But the world just got scary in the Middle East and Bitcoin tanked.
No.
Doesn't this drop completely shatter that core narrative?
I mean, it forces a massive reality check on how institutional money actually views the asset. What we're witnessing today is just the cold mechanics of a risk-off environment.
Meaning what, exactly?
When geopolitical fear spikes, large institutions don't reach for an algorithmic digital asset. They flee to establish traditional safety nets, like U.S. Treasuries or actual physical gold. We saw this quantified on the feeds today with major spot Bitcoin ETF outflows.
Let's stop there for a second. Explain how ETF outflows actually crush the price of Bitcoin itself, because it's not the same thing.
No, it's not. An exchange-traded fund, or ETF, issues shares that track the price of Bitcoin. But to keep the share price aligned with the actual asset, the fund manager holds physical Bitcoin in a vault.
Right.
So when institutions get spooked by Middle East tensions and sell massive amounts of their ETF shares to reduce their risk, the fund manager has to liquidate the actual underlying Bitcoin to give those investors their cash back.
Ah, so it forces selling pressure directly onto the blockchain.
Precisely. And we also saw Strategy Inc., execute a pretty rare sale of 32 Bitcoin today. When those institutional whales shed assets, it just triggers an algorithmic nightmare.
I sort of picture the crypto market structure right now like a precarious, tightly packed row of dominoes.
Oh,
You
absolutely.
have these massive institutions standing at the front. The macroeconomic gust of wind from overseas tensions hits. The institutions lean backward to reduce their risk. And by doing so, they topple backward onto the highly leveraged retail traders behind them.
And those dominoes fall at lightning speed because of automated liquidation engines. When institutional selling pushes the price below certain thresholds, trading platforms automatically, forcefully close out the positions of retail traders.
The ones who borrowed money to bet the price would go up.
Yeah. The exchange seizes their collateral and sells their position into the market to cover the debt, which drives the price down even further, triggering the next guy's liquidation.
And what was the total damage today?
Today, that mechanism wiped out over $1 billion across digital assets and forced $2 billion of leveraged positions into deleveraging. Bitcoin crashed because of market mechanics and institutional risk aversion, contrasting sharply with oil rallying on physical supply fears.
Which means institutional capital isn't disappearing, it's just migrating. And if you look away from the red in crypto, that capital is throwing an absolute rager in the tech and hardware sectors right now.
A total frenzy.
I'm looking at Marvell Technology. They are on a 25-year historic run. Shares are up over 7% this morning alone, and nearly 56% over just 5 days.
Those numbers are staggering.
Let's put that in perspective for you listening. Marvell now ranks number 22 in the S&P 500. They have a $269 billion market cap. A company that makes data infrastructure silicon is dwarfing household consumer staples like PepsiCo and telecom giants like T-Mobile.
And this capital migration into hardware, it's completely global. If we pull up the Asian indices on the stream, they're surging on identical fundamentals.
Yeah, I saw Tim Mo from Goldman Sachs made a big call.
He did. The chief portfolio strategist for Asia at Goldman just boosted his target for South Korea's Kospi index. Back in March, a target of 7,000 seemed pretty ambitious. Now he's targeting 12,000.
Wait, that's a 40% gain from its current level, isn't it?
Yeah, it's massive. And the Kospi, along with Taiwanese indices, have already doubled this year.
So what is the fundamental logic driving this? Why is hardware absorbing all this capital while other tech sectors are struggling?
It comes down to the mechanics of a capital expenditure supercycle. The broader market was completely underestimating the sheer physical infrastructure required to build out artificial intelligence.
Like the actual server farms and cooling systems?
Yeah, to train a massive AI model, you don't just write code. You need to string together tens of thousands of specialized chips in these massive, power-hungry data centers. Goldman Sachs is pointing out that this requires a continuous, multi-year pipeline of physical hardware. Hardware manufacturers are essentially selling the picks and shovels in the AI gold rush.
But not everyone gets to sell the shovels. I mean, look at Palo Alto Networks. They are a glaring outlier on our feed today. I don't really understand this market reaction.
It's a tough one to digest.
They posted better than expected earnings, upbeat results, yet their shares are falling. If we use a construction analogy, it feels like investors are throwing billions of dollars at the companies pouring the concrete and building the data center foundation, but they're actively punishing the cybersecurity companies hired to put the locks on the doors. Why?
Because investor patience operates on two entirely different clocks. For hardware, the revenue is immediate and tangible. A tech giant buys a chip, they pay for the chip today.
Right, cash in hand.
But for software and cybersecurity companies like Palo Alto, investors are obsessing over the timing of AI contributions. They want to know the specific quarter when AI integration will start generating massive new software subscription revenue.
So they're just impatient.
Completely. Even with solid foundational numbers, if a software company can't prove immediate AI monetization, institutional investors just take their profits and rotate that cash back into the hardware companies that are cashing checks today. Add in some technical changes to how Palo Alto reports its billing conventions, and you get a really solid company facing sudden headwinds.
Let's follow that capital further down the risk curve. We've seen institutional money flee crypto, and we've seen it flood into AI hardware. But what about the retail traders who completely missed out on the Kospi doubling?
They're getting creative, that's for sure.
Yeah, if the institutional side of the market is building data centers, the retail and decentralized side is operating a synthetic casino to try and front-run them. I'm looking at the breaking news regarding the SpaceX IPO frenzy.
Oh, this story's wild.
Everyone is anticipating this massive $75 billion public offering, valuing the aerospace company at nearly $2 trillion. The FOMO, the fear of missing out, is astronomical for you watching at home. But you can't buy SpaceX stock yet because it's private.
Right, it's entirely unlisted.
So retail traders are swarming a decentralized exchange called Hyperliquid to trade synthetic stock-linked perpetual contracts under the ticker SPCX. You have to explain what a synthetic perpetual contract actually is because the mechanics just sound insane.
The mechanics are highly complex, and they utilize something called the HIP-3 framework. Let's break it down. When you buy a traditional share of stock, you own a fractional piece of that company. You have voting rights, you get dividends.
Sure.
When a trader buys an SPCX contract on Hyperliquid, they get zero ownership in SpaceX. None. They're entering into a perpetual derivative contract, which is a bet that basically has no expiration date.
So who are they even betting against if the company isn't involved?
They're betting against other traders on the platform. If I think the pre-IPO valuation of SpaceX is going to rise, I take a long position. If you think it's overvalued, you take a short position against me.
But how does the price stay accurate?
The exchange uses a mechanism called a funding rate to incentivize traders to keep the contract price anchored to the actual real-world asset.
But there is no real-world public price for SpaceX yet. It's unlisted, so the anchor doesn't even exist.
Which is precisely why we saw an absolute bloodbath today. Because these tokens are purely speculative and highly leveraged, the order book, the actual list of buyers and sellers at given prices, is incredibly thin.
So any sudden move causes chaos.
Exactly. According to the data, a single large sell order hit the exchange today. Because there wasn't enough cash waiting on the other side to absorb that order, the algorithmic pricing plunged into a free fall just to find the next available buyer.
Oh, wow.
Yeah, this synthetic price crashed from $2,277 down to $1,254 in just 30 minutes.
And because of the leverage, that single order wiped out $1.5 million in notional value. And for those tracking the terms at home, notional value isn't just the small margin deposit the trader put down, it's the total leverage size of the bet.
Right, the multiplier effect.
It instantly liquidated over 400 retail traders. How can research firms look at a system where a single order wipes out hundreds of people during their lunch break and call it a structural rotation? It sounds entirely disconnected from reality.
Well, research firms like Capital Flows argue that despite the inherent danger of these flash crashes, the underlying demand is actually real. They point out that Hyperliquid's native token, PURR, is holding strong.
So they think it's just growing pains.
Basically. Their thesis is that crypto traders are exhausted by the volatility of digital commodities and are desperately trying to gain pre-IPO exposure to legacy tech. Even if they have to use synthetic instruments to do it, it's a symptom of a market starved for high-growth opportunities.
Well, if we are analyzing bizarre capital allocation and companies starved for growth, we absolutely have to talk about GameStop today.
Oh, the meme stock king returns.
GameStop just made an unsolicited, massive $56 billion bid to buy eBay, a move that eBay immediately rejected as, quote, neither credible nor attractive. Yeah, eBay is an enterprise roughly 5 times the size of GameStop. This forces the obvious question, why eBay? What is the actual corporate logic here?
We have to look at GameStop's balance sheet to understand the audacity of this move. GameStop released surprise first-quarter earnings today, posting a net income of nearly $390 million. Sales are up 14%.
What are they even selling to drive that?
The primary driver is physical collectibles. Funko Pops, trading cards, nostalgia items. But more importantly, because of massive share offerings during previous meme stock rallies, GameStop is sitting on a war chest of $9.7 billion in cash, cash equivalents, and derivative collateral.
Let me get this straight. They have nearly $10 billion in the bank and a core business model completely reliant on physical collectibles.
And that is the connection. GameStop has the physical retail footprint for collectibles, but they lack a dominant digital marketplace. eBay is the premier global secondary market for those exact items.
Oh, I see.
Yeah, GameStop's board is essentially trying to weaponize their cash pile to swallow the digital infrastructure they desperately need. And when eBay rejected the offer, GameStop retaliated by approving a $2 billion share buyback program through June 2029 to artificially boost their own stock price.
That is wild.
It is the institutionalization of meme stock energy. You have a corporate board operating with the capital of a major conglomerate, but the strategic unpredictability of a retail day trader.
Now, we need to bridge these corporate war chests, these localized market manias, and the global shocks we've discussed back to the underlying U.S. economy, because these economic realities are actively reshaping the American political landscape as we look toward the 2028 horizon.
This is where everything converges.
But before we dive into this political section, I really need to pause and make our framework crystal clear for you listening. NovaStream is a platform dedicated to the impartial reporting of breaking news.
Yes, absolutely.
We are tracking feeds covering highly contested, partisan political developments today. We are not endorsing any viewpoints, candidates, or policies. Our mandate is simply to convey the information breaking on the wires so you can understand the macroeconomic picture.
And that impartiality is essential because macroeconomics and politics are colliding forcefully today. The baseline economic engine actually shows signs of life on paper.
Right, the new jobs data.
Yeah, the ADP payroll report just dropped, showing U.S. businesses created 122,000 new jobs in May. Neela Richardson, the chief economist at ADP, noted that this hiring momentum is broad-based across multiple sectors heading into the summer.
That is the biggest increase in 16 months. But broad national data often masks intense, localized economic pain, which is really where the political maneuvering begins.
It always does.
Looking at the 2028 political horizon on our feed, President Trump was on Podforce One today, floating the idea that Vice President J.D. Vance and Secretary of State Marco Rubio should split the ticket in 2028, though he notably didn't specify who should be at the top of that ticket.
And that introduces significant friction. Vice President Vance is the presumptive favorite, the natural heir to that specific political base. By floating a split ticket without clarifying the hierarchy, it signals that the power dynamics for the upcoming primary season remain highly fluid and competitive.
But the true intersection of global markets and domestic politics is playing out right now in Iowa. Representative Ashley Hinson just won the Republican Senate primary there, defeating Jim Carlin. She secured the backing of President Trump, Governor Kim Reynolds, and retiring Senator Joni Ernst.
Which is a heavy-hitting lineup.
Yeah. Typically, Iowa is deep red. Republicans control the congressional delegation, the governor's office, and the legislature. A primary victory for an established incumbent like Hinson should mean a completely smooth glide path to the general election.
But the financial data tells a completely different story. The Senate Majority PAC, which is aligned with national Democrats, is pouring $13.4 million into ads, attacking Representative Hinson in a historically safe Republican state.
And what's their angle?
The angle of attack is purely economic. They're targeting her support for Medicaid cuts, but critically, they are hammering her support for the previous administration's global tariffs.
And this is where the entire board connects for you watching. Let's trace the logic from our very first story today, straight to the Iowa soil.
Do it.
We started this hour tracking drones over Kuwait and WTI crude futures spiking 10% because of supply chain panic. Who actually pays for that spike?
The consumer.
Specifically, the Iowa farmer filling up their heavy diesel machinery. That farmer is getting squeezed from every direction. They are paying the rising cost of fuel dictated by Middle East tensions. They are paying the soaring cost of fertilizer, which is heavily impacted by the retaliatory global tariffs the Democrats are currently weaponizing in their ads.
You are watching a global macroeconomic shock transform into local political ammunition in real time. Democrats see an unexpected opening because the agricultural backbone of the state is bearing the brunt of these compounded international costs.
Right.
The broad national jobs report we mentioned earlier means absolutely nothing if your localized operating costs are bankrupting your farm.
And the Republican establishment is treating this vulnerability with extreme urgency. The Senate Leadership Fund just made an initial investment of $29 million to defend Representative Hinson's campaign. Think about the scale of that.
It's massive.
When you see over $40 million collectively flooding into a Midwestern seat that shouldn't even be competitive, it tells you that internal polling is screaming about economic anxiety on the ground. A geopolitical conflict half a world away hits the oil futures feed, which drives up the price at the local gas pump, which suddenly turns a local Iowa election into a $40 million proxy war over global trade policy.
It perfectly illustrates our starting premise. There is simply no such thing as an isolated economic event anymore. The drone strike, the tariffs, and the political ad spend are all part of the exact same financial circulatory system.
So true. As we watch the numbers continue to flash across the NovaStream screens, let's recap the absolute barrage of data we've pulled for our highlights of the day. We started in the Middle East, breaking down how the threat to physical supply chains drove WTI crude futures through the roof.
While simultaneously triggering an algorithmic liquidation cascade that completely wiped out leveraged retail traders and dragged Bitcoin below $70,000.
We then tracked the massive capital migration into the physical infrastructure of artificial intelligence, with Marvell and the Asian Kospi indices surging on immediate hardware revenues, leaving cybersecurity firms like Palo Alto facing headwinds as investors demand faster software monetization.
We ventured into the decentralized casino, unpacking the dangerous mechanics of synthetic perpetual contracts that resulted in a 45% flash crash for SpaceX derivatives.
Yeah, and we analyzed GameStop utilizing a $10 billion war chest built on collectibles to launch a hostile $56 billion bid for eBay's digital infrastructure.
And finally, we brought it all back to the American heartland, seeing how global tariffs and rising fuel costs are squeezing Iowa farmers, turning safe Senate races into massive multi-million-dollar battlegrounds ahead of the 2028 election cycle.
From the hyper-abstract derivatives on hyperliquid to the physical price of fertilizer in the Midwest, the markets are forcing investors to navigate extreme contradictions.
They really are.
Which brings us to a final thought for you to ponder long after you step away from the ticker today. We spent this session highlighting the tension between physical reality and digital abstraction. We live in an era where you can log on to a decentralized exchange and trade a synthetic derivative of an unlisted space company against a stranger in a matter of milliseconds.
Yeah.
Yet the moment a traditional physical global conflict flares up, those digital abstractions are instantly liquidated for cold, hard cash. As our financial systems become increasingly detached from tangible assets, trading perpetual contracts of pre-IPOs and obsessing over AI monetization timelines, are we actually accurately pricing in the real-world risks that govern our lives?
Or, as you watch the spark lines paint the screens around us, are we all just trading shadows on the wall?
It really is the defining question of modern finance. When the shadow detaches from the object, which one dictates the price?
That's the billion-dollar question.
That is going to do it for our highlights of the day. A huge thank you to you for joining us and cutting through the noise. Remember, NovaStream is live 24/7.
Always on.
The charts are always dynamic, the news is always breaking, and the data never stops. Keep watching the feeds, and more importantly, keep questioning the mechanics driving them. We will see you next time.